Welcome to the podcast with Paul Hill, full-time equity analyst. I was going to start off with a Brummie accent and very enthusiastic. Paul didn't like it. He stopped recording and said, don't do that, don't monkey around. And I love your enthusiasm for stocks, Paul. The way you open interviews is amazing, right? Most financial podcasts are boring by middle-aged white blokes who just bang on about sort of, financial ratios that no one can buy into. The difference is with you have enthusiasm. I do. We love investing. We don't do it because, listen, the PE on this. That's the difference. I love enthusiasm. And I'm trying to drag people in, as you are, with our enthusiasm because it can change your life. There are people out there working 9-to-5 jobs in crap, boring jobs they hate. They're just doing it to pay the bills. But they want to be investors. They want to have a bit of wealth behind them. They want to build their wealth. They want to learn to do it. And they'll do that by being enthused into it. I was told once by a very good broadcaster, enthusiasm is infectious. And if you have passion for something, share it. It's like that joke, isn't it? If you're happy, show your face. Let your face know, If you are loving something, you've got to be enthusiastic. And you didn't like me starting the podcast then with a good Brummie accent. It was an excellent takeoff of you, but it was flattering because I like the way you start something. You're a breath of fresh air. You say, welcome back, everyone. Welcome back. I love that.
Okay, well, thanks very much, Justin, for
your enthusiasm. No, listen, your enthusiasm for stocks you genuinely believe in, right, is worth 10 times, 100 times more than any financial ratio you can ever describe.
I like the financial ratios, though.
No, honestly, it is. If you honestly believe in something from the heart, that says a lot more about a stock than any sort of EBITDA margin.
You sound as though you just had a couple of Duracell batteries given by your wife into your back. Anyway, should we move on to the serious stuff?
No. What we don't want to do is serious stuff. Everyone does that. When I first listened to the podcast, when I first started, I thought, is this what it's about? There's a guy from Barclays Stockbroker was banging, he had a double-barrel surname, banging on about stuff. And I thought, I turned off after 5 minutes. He is so boring. That's not going to get any new people into it, apart from the old city crowd, private school boys. That's not going to get anyone into investing. And investing should be for all. But anyway, let's talk about markets. And that's the thing, it's not for all at the moment. It should be for all. It's getting that way, I think.
Okay, right. One question here, Justin. What do you do about the fallen angels, real high-quality stocks that go through a temporary tough period, the shares sell off, and they give an opportunity? What do you typically do of these sort of like fallen angel type opportunities? Because I've got a couple that I'd like to chat.
Do you know, we had a sell-off recently in small caps. I don't know what happened, some rotation players happening, whatever. And so small caps sold off, but the big indices, FTSE 100, were doing okay. And Nasdaq was hitting all-time highs. The Dow was doing well. I thought, what's going on? People said, what's going on here? And I said, generally, you can only generalize, of course, but I mean, when you've got sort of new startup companies and maybe they're a little bit overvalued, generally, they are the hardest ones to fall on. In a sell-off, when you've got especially inflation worries and interest rates hikes around the corner in 2023, like you said, these long-dated assets, these ones that are, basically they're on super PEs, or if they have a PE, or they're on multiples of 100 times their revenue or whatever, they take a big hit, don't they, in downturns generally. That's why you should always try and buy, growing stock, like say a GARP stock at a reasonable price, because then at least if you get a good price to start, good value for money, it won't take a big hit in a sell-off, really, because it's near where it should be valued anyway, hopefully. It's not overvalued. But I just think you've got to be careful whenever you invest in a company. Try and get good value for money, because when you start off, because then that'll sort of insulate you a little bit from these sell-offs. Like these fallen angels, are they high flyers? Are they valued quite highly? Maybe, because if they miss a forecast, then they take a massive hit, don't they?
Yeah. Well, I mean, there's been a couple actually, which is over the last sort of couple of months. But the first one, I'd point investors to have a look at. I don't own the shares. I mean, as you know, I don't actually have too much spare cash. But I class it as a super high quality AIM stock. It's about market cap of about 840. It's Clinigen. That's the ticker, CLIN. Now the shares back in 2019 used to be up about over 10 quid. They're today roughly trading at about sort of like £6.20, I think, or £6.25p or something like that. And the reason why they took a bashing just recently, they fell by over 25% on the day on a trading update full year, was such they're split into two divisions. I mean, they're a healthcare stock, and they've got two divisions. One, they're a world leader in providing drugs and doing clinical trials for new innovative treatments. So they supply the sort of, not the placebo, but effectively the best-in-class comparator. So when you compare against like a new oncology drug or something, they'll actually bring the base drug and help the actual company through that. And they're the world leader in that. So that's their services business. And then they've also got a products business, which is they've got one of their lead oncology treatments, drugs called Proleukin. Now, they've been hit by the pandemic in two areas. First of all, is because actually oncology treatments in hospitals, not surprisingly, and prescriptions are down massively due to COVID. But that should all start coming back. And then the services business, the clinical trials business, has also been hit because obviously the whole hospital system has been trying to test stuff on, and just treat patients with COVID. So a lot of the clinical trials have been pushed to the right as well. Now, say the shares currently trade at roughly round about 10 times PE and 10 times EBIT for if you believe the forecast for 2022, not for 2021, because they've obviously been knocked. And the reason why one of the reasons why the market's getting a bit skittish is they've got quite a high level of debt, which they need to sort of like, it should be about £330 million. But that should equate to still within their banking covenants. And the following year, they'll generate shed loads of cash. So this is a really interesting play that I don't own. And I'm actually speaking to probably the best investor on AIM in anything to do with life sciences and medicine. And I understand he owns the shares, Christopher Mills, on Monday. So I'll highlight to investors, have a look at this stock. Because it's a big firm, it's a big company on AIM. I think it's a really, sort of like high earnings, high quality business that people should should really have a good look at this, because I certainly am. I'm actually waiting until I speak to Christopher Mills on Monday, because I'll be really interested to hear his view. He's one of his funds has got a big chunk of it. And I think, and coming back to that original question, what do you do with fallen angels? I think he'll tell me what he's doing with it. He'll be buying more. He doesn't think it's. I mean, the big question is it a fallen angel or is it a value trap? And I have heard the latter labelled it a bit. But I look at it and say, well, actually, this is a top quality business that is trading at a real discount. And given it's quite a big AIM stock, then it's good for things like, IHT. It's easily liquid. So it's something to have a look at.
Have you seen the holdings in the companies there? I mean, Jupiter sort of, have reduced after that. It seems like a drop off a cliff there. And then and Slater have increased. They've got the sort of almost nearly 6%. I want to say things like this, especially when you have a worry or a drop off a cliff like this, you've always got a bit of time, I think, to like you said, like you're doing now, to just analyze it, read up and check the valuations, check how it's going, because I see people on falling knives sometimes trying to catch falling knives too early.
Yes.
Leave it a little bit, because it takes a long time to get back to normal. It may rally a little bit, but yeah, I just think take your time to assess this. Sometimes opportunities, aren't they?
That's right. And the other thing for this type of sort of stock is just how long is your time horizon? If you're looking to trade it, forget it. Yeah. Don't even think about it. But if you're looking for a sort of like a 2, 3, 4, 5 year investment, I actually believe this could really be it's going to be one of those things that won't actually shoot the lights out, I don't think, but I could easily see it doubling its money in 5 years, no problem at all. I'll be just getting back to where it was in 2019. So it's certainly something to have a look at. And as I say, it's right on my crosshairs, right on my watch list. And another one that has been absolutely mullered over the past 12 months is Blue Prism. Now, you're probably familiar with this. It's robotics software automation. Yeah. And the reason why I alert investors, I spoke to another really super smart investor, James Thorne of Columbia Threadneedle. I interviewed him about 3 weeks, and he went through it. And I said to him, look, this has got sort of quite a few hairs on it, and it's been up and down. It's currently trading at roughly around about, its market cap of just under 800 million, I think. Shares are roughly, I'll just have a quick look now, actually. I think the shares are
832.
Yeah, that's right, about 820, 830, something like that. But interestingly, they're valued at roughly around about 4 times sales. Yeah, if you strip out the cash, they should have year-end cash of about 100 million, 110 million pounds. So they've got plenty of funding, no problem at all. Now, their biggest competitor, the world's biggest, is called UiPath, and that's actually UiPath, not part, UiPath, ticker PHTH. Traded on NASDAQ. It's worth 35 billion, and it trades at roughly around about 40 to 45 times sales compared to Blue Prism's 4 times sales. Now, this whole area of software automation should grow at roughly 20 to 30% per annum organic, and that's what the experts like Gartner reckon, to hit from about $2 billion per annum at the moment to 20 billion by the end of the decade. These guys, Blue Prism, have roughly 20% of that. And the thing I really like about it, and certainly off air, I actually sort of probed James Thorne about it, is that they don't just do software robots to replace people. They do it to replace teams. Now, that's really interesting because that's the hard bit. If you've got somebody who basically just data inputs, that's a piece of cake. You just basically get some software and just be able to lift and shift it straight into, do what he does or she does. But if you've got a group of people, sort of 10, 15 people, etc., all working together, you can't lift. You want to lift and shift part of their job, say 25%, 30%, or you want those people to interface with it to make it more efficient and improve productivity. Something that banks really need. I mean, I've seen an analyst, Mike Mayo, out of I think he's one of the big institutions. He reckons there's going to be 200,000 people in the major bulge banks who are going to be replaced by this type of software. You saw Lloyds the other day closing more stores. And what this does is just improves all back office automation, but it's so difficult to actually put in effectively software robots to work as effectively team people. And that, a skilled software person to help side by side with a person to improve their job, to remove the menial stuff and to work seamlessly within teams. And this is what these guys do. Now, I've sort of communicated a bit with the CEO, James Kingdom. I'd love to get him on to actually interview him to really sort of pick his brains. But again, I would alert investors, this looks like a fallen angel to me because it used to be trading at about 20, 25 quid. The multiple is 4 times sales compared to its biggest competitor at over sort of 40 times sales. And yes, it's loss-making, Blue Prism, and it spends probably too much on sales and marketing, but that's under his control. So in the fullness of time, that should come down. And also it needs to spend more on, and it accepts it needs to spend more on R&D and software development. So it's a really exciting area. It's gone out of favor, but I can actually see that one doing well. And again, it's something that I'm going to have a good look at because, well, I'm already having a good look at it because I think it's a great story.
Yeah, it's came on my radar a while back. I was looking at these because I was looking at AI, robotics, going to be next hot areas. And when I invest, I look at trends like that. And I actually looked at the tweets I sent, and I looked at it dated 24th of January, 2020, this is. And I say, been watching Prism for a while, very hot area, robotics and AI. The hope is much more than priced in, valued at 1.3 billion, this was back then, 12 months revenue of 101 million, loss of 78 million. Yeah. CEO obviously changed now, AstraZeneca exercised options yesterday from IPO at 78 pence. Price now at £15.59. Paper profit there on options 7.3 million. But yeah, it flew out of the gates because they really, even the name Blue Prism, it worked. It fits that really hot area of robotics, AI. But yeah, now the hope and hype has come out of it a little bit, I think, now, because before that was all priced in. But yeah, now is the time to sort of do some research on it, definitely.
But their customer list,
not going away, is it?
That's right. And their customer list is fabulous. They've got 60% of all the major European banks, for instance. Yeah. I mean, that is a massive area of back office automation. But as I say, if investors take two things away from it, right, their USP appears to be that their software and their capability can absolutely replace the menial tasks done by a team, not an individual. They can do an individual, but a team, which is really tough. That's one. And then the other thing is just the valuation. They're effectively on 10 times less rating than their nearest competitor. out in the States. I mean, admittedly,
to be fair, the cash burn's coming down a bit now, isn't it? Net cash use has gone down, and so massively from 32 million to 8 million in the last half. This is H1, first half interim results. So and 80 million revenue, up 24%. So growing there above 20%. That's always good to look at. But I mean, it's hot, but the chart is like a hammering, isn't it? You're looking. Just gone down. But
I love those. I love those as an investor. I love those type of opportunities. Clinigen and Blue Prism are definitely something to stick on your watch list. I haven't bought any, but I can tell you if I get some spare cash, that's probably two areas that I would certainly have a good look at.
Where would you get your spare cash from, though?
Well, exactly. I need a takeout or something like that. But that doesn't, which actually might not be too far off. Anyway, we can talk about that later point. Another one which has been hammered this last sort of week, which I really I've been scratching my head on, is Avacta. They basically on Monday they announced that they'd just signed their first European or EEA in the UK distribution agreement with Calibre Scientific. It's a non-exclusive deal, but basically having got the regulatory approval and CE marking, they can now sort of like start commercializing their rapid lateral flow test, not only in Europe, but across the world. And so they signed their first agreement, but they got a massive wave of selling off the back of it. I was very, very surprised. Obviously, probably a lot of people just sort of profit taking. But I mean, the shares
that's
have
a big volume there. Look at the volume of the chart. That's big. Why was that? Seems like
I don't know.
Investors.
I know it was absolutely, but I had to look at it, and I think a lot of it was. I think most of it was. So I mean, all I would say is that the direction of travel is positive on the news, and for the shares to sell off so badly, I was very, very surprised. But anyway,
it's a scary looking chart. That though, it literally is very volatile. It goes up, comes down, and it gets into a bit of a pattern of formation, and it drops off a cliff, and then it rises back. It seems. Do you know what? If you look at, I don't know when the results were last time. The 10th of November back in 2020, and a big fall off a cliff there. You're talking like 35% down, and it's grinded up now higher again. So look at the previous falls. It's not unusual for Avacta to do a big fall and just recover. It's done it before.
And also I'd say, and I've discussed it many a time, lateral flow tests and PCR tests aren't going away anytime soon. I mean, you probably saw and stuff on the news yesterday that the Silverstone British Grand Prix is going to have 140,000 spectators, over the weekend. Now, every single one of those guys has got to prove that they're COVID-free, which is going to involve a rapid lateral flow test or a PCR. Likewise with the Euros, England are playing against Germany. I don't know if you've noticed on Tuesday night, 45,000 people are going to attend at Wembley. Every single one, again, has got to prove it. And my daughter, luckily, has got tickets to go and see Wimbledon men's semi-finals. Every single day of that, everybody, before they go into the championships, has got to prove they're COVID-free. The only way you can do that is basically you've got to have a PCR test and a rapid. So domestically wise, there's going to be still masses and masses of these tests, happening.
Yeah, I think as the economy opened up and these mass events opened up, you're going to need more of them. In fact, you know what? We've just been caught out. We did book. We thought we were clever. We thought we need to get. I love holidays and the wife. Well, in fact, I go along with them. I get into them after say a few days. I find it hard to switch off though. We booked a holiday to Portugal. Then it went on the amber list, which is annoying. Yeah. Still go, but you've got to have some holidays, so we don't mind self-isolating. So I can work from home anyway, and the wife. But we got to have tests, like tests there, tests back, all that stuff. So after I think 72 hours and 5 days and 8 days tests. So that's a lot.
Are you doing it, or are you going away, or you decided to kibosh it?
Well, my wife's on the phone now trying to change it to the Balearic Islands now.
Okay, you're gonna go to what the Ibiza are. I'll tell you, mate, they'll be absolutely jam packed. Nightclubs and beaches there will be rammed, absolutely rammed.
But the part of me is thinking, surely now I'm just logically thinking it through. If you are double jabbed and you test negative, right, then why should you have to self-isolate? Just do more tests. If you've been double jabbed, just run the tests up. That's the way isolating. No, if you haven't got it, why are you isolating? I don't understand. It doesn't make any sense. So surely the test's the way out with a double jab. That's the combination, really.
Yeah, the thing is such that they're worried that people won't actually follow the rules, and so as proved with the Indian variant, So when they come back, they'll just basically either not test themselves or not self-isolate. So that's why they're sort of like hesitant about recommending anything on the amber list that people can go on holiday. That's really the sticking point. It's not so much the self-quarantine. They're still sort of like saying that people shouldn't go on holiday to amber countries, which is, you know, which is really what's stopping it. But
I feel like saying it was a green country.
Yeah, exactly.
I know. But also they changed it straight away. They're like, oh, it gives a chance.
Yeah, I mean, there's one thing which is good about it. Yeah, I mean, I know it's going to be for foreign holidays. That's pretty terrible. But you don't see many of the UK tourism, you know, hotspots. You don't see many of the restaurants, pubs, not, you know, all these kind of places complaining about overseas holidays, because these guys in the UK domestic are going to have an absolute field day this summer, and already are. I mean, prices are up, bookings are up. You can't even get a campsite more than, you know. I saw one on the cheapest campsite in Cornwall for a week was £750. That's over £100 a night to pitch your tent, you know. And there was a caravan up in a field in Cornwall, sort of like a week ago, which was £4,000 a week. You know, when you think about that, wow!
Yeah.
So that's, you know,
the prices are going mad. I know it's an odd situation we're in, but listen, and I'll bring it back to stocks here. But domestic hospitality, leisure, all that doing well. In fact, there's a trading update from Escape Hunt on Monday. Escape Hunt. Escape is one of my five core stocks now. That's what I'm going with. Escape Hunt's one, Gfinity, Polarean, Trufin. The fifth one I'll be revealing on the weekend with a video. I'm not going to tell you yet. Members of the club will know about that, but it's my fifth one. I'm sticking with 5. Paul, I'm going to take your advice.
I think I know what it is.
Be more patient. And be more patient and hang in there for longer, right? Longer and longer. And I'm going to hold these 5 stocks the rest of my life. unless the story changes.
No, you're not.
No, listen. I'm minimum. I want to do 5 years with them. If they're still improving, I want to do that. I want to do 5 for 5. And I just want, because I've been reading lots of books. And essentially, the secret, if a company is growing, it's improving. The secret is just holding on. It's the hardest thing to do. You know, it's acquired quality that most people can't do, because as humans, it's hard to do nothing. We're not wired to do nothing. We are wired to do something, you know? Yeah. So fiddling around at the edges, selling, trading, people do that and find it more natural, and a bit of a worry, share price goes down, oh, I'll jump out. And so, yeah, I'm going to try my best to have a bit of discipline. I like the company's done plenty of research on them. I like where they're at, the sectors they're in. I try to hold them, you know, and see what happens there. Well,
I mean, not only has Avacta got a big runway ahead, but another one as well, which was Belluscura. They said this week that they do portable oxygen concentrators that help people get out of hospital, because essentially they're stuck on, you know, ventilators, or they're trying to get some oxygen and stuff like that. And they allow people to not only survive, but they can, you know, these portable oxygen concentrators deliver the right amount of oxygen from air rather than from a tank. Anyway, they signed their first distribution agreement out on the east coast of the States. More will follow, and then that's a great one. Another huge runway ahead for a leading, you know, technology business.
There was an article on that, wasn't it, about old-fashioned oxygen? I saw that in BBC. I think you tweeted as well.
Yes,
about ventilators in our system, very old, and the upgrading and all that stuff. Yeah.
So I mean, the UK needs them as much as sort of like, you know, the rest of the world, but particularly places like India and Brazil and these kind of places. So it's a sort of like, it's a first distribution agreement. They've got to get the manufacturing up operational wise, but let's see how they get on. But obviously it's a very good product. It's best in class. And they've already started taking, you know, orders for it. So that's obviously got to be good.
I tell you what I like is when you get news like that, though, it just confirms, you know, the investment. I mean, today or 2 days ago, I don't know if you saw long COVID. There's about 2 million people in the UK alone now long COVID, they're saying. And I thought, wow, that's really scary. And they can't. One of the problems is they can't analyze the problems. And I was thinking, well, that's Polarean technology down to a T. They just done a study with Oxford University where they picked up issues of the lung, which MRI, CT scans couldn't do. So I'm thinking, and the government said we're going to spend a lot more money in investigating this long COVID. And I thought, well, there we are. There's a product right there for you. You need that. And if you haven't got the best tech, you can't do the job. You can't diagnose patients if you can't find the problem. So
I mean, just on that one, with the 2 million long COVID plus the 5.1 million on patient waiting lists in the UK. I mean, that just plays straight into the sort of the playbook of Totally, who do, you know, NHS 111 services and also insourcing. And these guys are just, and there was an interesting article, wasn't there? I think it was on the BBC today as well, saying that a lot of children are actually getting infections and are going into A&E and blocking those guys out. So what's happening is that, you know, Totally on the 111 service are actually fielding that and doing the triages for a lot of these children. I bet I think they're coming out with a trading update half year, roughly in July sometime, and I expect them to be doing very well. Not only because obviously they're trying to help the NHS get through this massive waiting list, but also they'll be helping them treat patients in doing the triages with long COVID, and then all obviously these youngsters, these children who are also. So I think, you know, that's a very good place. And I remember speaking to the CEO Wendy Lawrence I interviewed her about 2 months ago. And I think the turnover is roughly 100 to 110 million at the moment, something of that sort of ilk. And I can't remember what the actual EBITDA is, but I think it was sort of like, you know, 4% or something like that, maybe, because they're just really sort of moving into cash profits. But I could see this business in 5 years hitting 200 million turnover with a sort of, you know, 10% EBITDA, which would be 20 million. And on that basis, you'll more than double your money. I'm absolutely sure on it. So again, it could be just a very easy company that's going to do well and help the country get through this huge, you know, sort of plague we have of patient waiting lists, COVID-19 and stuff like that, and help all those patients who are suffering badly. So they could be in an absolute perfect place at the sort of the right time.
Do you know what? That's another company I bought right and didn't have patients. Well, they had patients.
Well, there you go.
But group turnover there at half interims, 54 million, EBITDA profit 2.3 million. Yes, it's and that's gone up. You know,
yeah, and whilst we're still on the healthcare and the COVID side of it, one other company that I know you absolutely sort of like gave me a kicking when I mentioned to it, when I remember I bought Gilead Sciences. Well, they're leading treatment. I mean, I bought them for their oncology franchise and also HIV and their hepatitis franchise, which is absolutely world class, and all their, you know, sort of like antiviral technologies. But as you probably remember, they came out in April April the 23rd of 2020, sorry, they announced that their sort of like lead antiviral, their lead drug, remdesivir, was help patients hospitalized. Well, they did a real world clinical trial. It's been of 98,000 patients, so some pretty damn good data. And what it did was actually statistically, it reduced the level of mortality by 70% for those patients in hospital which were on sort of like low flow oxygen, so low flow ventilation. And remember, this is the drug that they used for Boris Johnson when they got off the, you know, to help him through it. So that's actually quite a good helper. I mean, it's a bit like the steroids, you know.
How is Gilead going? How's the share price going?
Well, it hasn't really moved. I mean, that's what, you know, it's about the same as where it was. I mean, it's still trading at sort of 10 times 2022 earnings, which frankly is really cheap for a quality healthcare stock. So, you know, it's worth having a look at. And the other one which is doing really well, which I've, you know, only had a half position, but it's still a chunky number, was AstraZeneca. And just about every single day they come out with some sort of like oncology, you know, they get another indication, another regulatory approval around the world for their leading franchise of cancer treatments. And they're all sort of like immunotherapies, absolutely fabulous. And because of that, their shares were knocked because of all the criticism they were getting with regards to their, you know, vaccine and potential litigation. I mean, they've done really well. They're up around about 20% since I bought them, and you know, I think they're gonna. I mean, I've done the valuation of Gilead. It currently trades at 67. I could easily see that well above 100. You know, $100 per share. I mean, that will be, you know, it could well be $140 per share. But if you just used a sort of like a 14, 15 times, you know, PE multiple. So if I just did the maths, it was sort of like 6.7 times 15. I mean, that's $100, and that's just on a 15 times PE for 2022. And as I say, for Astra, I think that's, if you use a sort of like a market multiple for its growth, that's going above 100. And when I worked it out, it's going above £110 per share. And if you work that out plus a 2% or 2.5% dividend, you get us like a 14% gross return over the next 5 years. So nothing stellar, but I mean, these, it's like elephants don't gallop, but these things seem to be, got good potential to gallop.
I probably mentioned this before for you. There's an indicator on the chart called the RSI's Relative Strength Index. It's just based on the volume, the price action, and how much volume and price. And it ranges from 0 to 100. They say above 70 is overbought, it's getting too hot. Below 30 is over. So every time AstraZeneca has basically hit RSI 30, it's a buy. Simple as that.
Yeah, well, there you go.
So recently did it in 3rd of March, and then going back, the last time he did it was March 2020. It was a dash for cash crash, of course. But literally every time he hits that, top up, and he'd be doing well. It's simple as that.
Well, it's a quality company, no doubt about it. I mean, I was on absolutely first-rate sort of oncology franchise. And another one which came out with some really good news, would have actually have a big position, is Northbridge. And this was sort of like we spoke, I think, on 2 weeks ago, and then they came out with the trading updates on the Tuesday, and I interviewed their exec chairman, Peter Harris, and the restructuring story is coming on strong. They've converted their debt, their £4 million of debt, into cash. They're paying most of it. They're paying 75% of it off in cash, which is great, which is non-dilutive, and then a little part is going into equity. And I mean, the business seems to be doing very well. The main crown jewel, Creschick, the load bank business, is absolutely flying. I mean, it just needs more capacity, and they're bringing 50% more on, hopefully by sometime next year. They've got planning approvals to do that. And America desperately needs their sort of like their load banks. And what's really interesting is that they help network stability and testing and commissioning backup power supplies. And you put yourself into a critical business, a data center, a hospital, or even an office, in the city running all of its computers and stuff like that. If the network, the grid, has got a lot of renewable power, which is intermittent, and it doesn't, it's either it's not windy or it rains, it's cloudy, and it basically knocks out the network, then that's a problem. But also, what happens, and I hadn't really thought about it before, what happens if you get basically a cyber attack on the grid? Well, the same thing happens, and it's that potential problem, the actual fear of having a blackout, that's driving more industrial users to have backup power supplies. And every single one of these needs a load bank to be able to commission and test it. So I think they're absolutely in a brilliant position. There's a massive runway ahead for that division with Creschick. And then the other part of the restructuring story is the potential disposal of Tasman, its sort of geothermal and gas drilling tools business. And it looks as though that is sort of on track. I mean, I look at it as a win-win situation. If they get an acceptable price from a potential buyer, then they'll sell it. If they don't, they'll hold on to it. And actually, the gas and the geothermal drilling part of the business is going to get better and better because, prices are firm, more exploration, the economy's coming back. So I could see that and the operating leverage of that is very good as well. So if they have to hold it for another 12 months, then fine, because I think they'll get a much better price. But so I class that as a win-win situation. The big picture is such that I think, the management team there, led by, Peter Harris and I think the CEO, Ewan Thomas, are doing an absolutely fantastic job. They really do. And the return on capital employed for the Creschick business is going to be, it was 15% during the pandemic. It will be over 20% again, which it was in 2019. So you should generate a lot of cash and a lot of return once this whole restructuring story happens. And I know a lot of people are now starting to have a good look at this. I interviewed one of their biggest, in fact, I think their biggest shareholder, Lawrence Halls of Gresham House Strategic. And if everybody wants to get his view, then listen to it because, he's very positive on the story of Northbridge, and I am as well. So I'm absolutely delighted.
Yeah. And do you know what? I've got to say, I've got to applaud you for getting the high level of quality you have on these interviews, because it's worth looking at, because you get, most private investors don't get that perspective. of what, the rationale behind why they invest.
Yeah.
And you can learn a lot by listening to how these guys, why they invest and their reasons behind the investment.
Yes.
And, okay. And then it'll help you in future think, okay, I'll look at that then. That's one thing I hadn't considered. And so it's worth listening to these guys.
Well,
they're trained, they do it for a living, you know?
Yeah. I mean, you raise a brilliant point. I mean, as I say, right at the start of of our chat, I'm interviewing Christopher Mills on Monday. He is the #1. I would class him as a titan of mid and small cap investing in the UK over the last 40 years. He's got an absolutely fabulous track record, and particularly in healthcare and life sciences, most of his peer group look to him for the lead. He's like an anchor investor, and they defer to his judgment because he's done so well consistently over so many years. And as I say, I'll be fascinated to hear what he has to say, and particularly about Clinigen, because I think it's a fallen angel. I think he'll be adding to his position down at these levels. But let's wait and see. I don't want to put words in his mouth, but he's definitely worth having a listen to. One question here for you, Justin, which I've been sort of had from investors. You get them occasionally and stuff. Is what's your view on stock buybacks? Because there's been masses and masses of this, particularly out in the States. It's just, are you favourable?
Well, it's odd. I know a while back when I first started years ago, I invested and listened to people like Buffett and all that stuff. And he's a big fan of them, isn't he? But not just willy-nilly stock buybacks.
Yeah.
They've got to be done at a good level, good price. Because and in my head, I've always had issues with it. I've always I did start off in bigger caps, but gone down the sort of market cap spectrum. And there's very few stock buybacks of small cap companies because they do the opposite. They tend to dilute, not concentrate. So in your head, you have to think like that. Really, it's the opposite of a fundraise, an equity fundraise. Essentially, they're reducing the amount of shares in issue, so you own a bit more of the company. But like I said, with a lot of companies do it willy-nilly, don't they, and just buying back on a regular basis. But I mean, I know Warren Buffett's a fan of, if you can't find anything better to invest in, or is no acquisitions out there, then and you think your company is cheap, and it's a good deal, buy your own company, and that's what he thinks. So I suppose.
Yeah, I mean, if you look, the reason why I mention it is that a lot of investors have sort of put their money into things like Apple, which is doing $90 billion this year on buybacks. Microsoft's doing it. I think even Amazon's doing buybacks and stuff like that. Now, the rough rule, the golden rule, I would point investors to just think about is where the company is buying back its shares at below its intrinsic worth, then it is value accretive. Okay. Now, if you've got because it actually could happen quite a lot in the UK, particularly with the insurers and the banks who currently are trading below net tangible assets. Okay. Now, the likes of Aviva have got a lot of spare surplus cash, as you know, I own. Lloyds also I own a reasonable chunk of, and they're going to be allowed to do dividends and buybacks and stuff fairly soon by the regulator. And I would say where they are effectively value accretive, i.e. below tangible book value, and they think their return on capital employed is going to be at least equivalent to their cost of capital, then it makes perfect sense, because effectively it's concentrating the ownership with the existing shareholders and improving their returns, juicing their returns, just makes absolute. But it's the criticism I have of stock buybacks is where people do it, particularly at the big companies, way above the intrinsic worth of the value. So it's destructive on that value. All they do it for is to shrink the share count, increase the EPS, which is not necessarily value accretive, because they can't get any return on their cash, because it's essentially at zero in their bank. So they say it's earnings accretive, but it isn't value accretive. And all they're doing it by shrinking the share count is to improve their LTIPs and bonus payments, and that's why it's got a lot of bad press. It's such that people do it for non-shareholder friendly reasons. They do it for their own, to trigger a big LTIP on the back of it. But that's how I would, for that question I've had on buybacks, that's how I would view it. And with small caps, coming back to your sort of your comment, most of the time you don't want small caps buying back their shares, because it has two things. One, it reduces the liquidity. It reduces the number of shares which are tradable, because it buys them off the liquid part of it, the free float. Plus, it suggests that it's actually that company may have gone ex-growth, because it has nothing else to do with its cash. You can't invest organically, and you can't invest in M&A. So I think that's one of the reasons why a lot of the time Most small companies don't, but for big companies, it makes a lot of sense. You know, as long as they're trading. I mean, I could see Aviva and Lloyds eventually doing quite large buybacks, which would be perfectly good for, you know, bringing the shares more in line with what their intrinsic worth is.
Yeah. Well, I know one of the companies on my watch list. In fact, they've been on the podcast quite a few times. Arix Bioscience.
Yeah.
They started a share buyback in March of this year, and every day now going to RNS buying back shares, and the share buyback is up to 25 million. And they've done they're doing very well actually in the oncology field, because they early investors in oncology startups and all that stuff, and they've done very well with some FDA approval, some listing. But yeah, so the market cap is 243, and they're going to buy back up to 25 million. So it's worth looking at, because the share price has done very well recently. They did a couple of deals, but then it's gone sideways for months now. But they're buying back shares every day. So it'd be interesting to see if that has any effect on the share price there. But
yeah, I mean, another company which is actually which I own is Sage, which is authorized to do buybacks and has been doing it for some time. And again, that company's done. I know you don't like it, but I mean, I basically bought it at about, I think it was 580 or something. I'm at about 680 now.
It's not I don't like it. It's just doesn't tick my box. You know, I genuinely now, I'm trying my best, and I'm to say to a lot of people, I'm trying to look at the businesses, not the share prices. And I'm trying, and I've got to have some kind of interest in the business. You know, it's like anything. It's like if a friend of yours asks you, Paul, can you help invest in a business of mine? And he's a friend of yours, not listed, a private business. I think that, you know, rather than just doing you a favor, you'd have to have some kind of interest. Or do you fancy going halves with me on this business? You'd have to have some kind of interest in the business. You know, and so Sage, I understand. You know, it doesn't interest me. That's all. I mean, I'm not saying I don't like it. It doesn't interest me. You know, more you than me, because. You are you know, a talking fact sheet, spreadsheet, a world of facts and information there. So I can see why you like it. But do you get that? Though? Do you find you have to be a little bit interested in the business itself to invest in it, or not? So you don't need to worry about that.
Yeah, no, I'm with you. You know, as long as you've got a passion for that business, I wouldn't. There's certain stocks I just don't invest in because I don't ethically agree with them. But most of the others, I mean, I'm genuinely interested in most businesses, most sectors, and stuff like that. And you know, I would, you know, get my hands involved. But you've only got a certain amount of money, and you can't invest in everything. And there's lots. I think even though my share portfolio is at its highest ever at the moment. I don't want to sell anything because I still think there's a big runway ahead on all of them, and you know, it's basically but also I'm seeing lots and lots of really good opportunities outside. I mean, there's A2 today. You know, you look at sort of the blue Prism, and you look at sort of like Clinigen, just come up, you know, on the radar screen. It's like, as I say, it's like London buses, isn't it? They just sort of come around. And,
exactly. And the same guy, I kept trying to say this to people in the club. I said, listen, I was going to increase my holding in one company. I preferred another company. I said, no, do you know what? And more research is reduced in one. I said, that's not to say that one won't do very well, but all you have to do, there's plenty of opportunities, but you've got to concentrate your money on the ones you like the most or think will have the most. Doesn't mean that other one's going to do better than that other one you've reduced on could do a lot better than the one you decided to take a punt on, but it doesn't matter. You just have to, you can't just dilute and buy everything in the market. Otherwise you will be the market. You may as well buy a fund. So I mean, it's just knowing. That's why I'm only going with 5 stocks, core 5 stocks, because I don't want to dilute my holdings too many. Even though there's plenty of opportunities, like you say, blue Prism there now. It's too big to me, but I mean, I like the chart. I just like to see where that chart's going.
Hey, but it's good and liquid. If for somebody like me, you know, you can stick a big chunk of money in it. Anyway, so
one other thing. Do you ever feel like going big? I mean, if you see a small cap company and you've got a decent chunk of change, do you ever feel like, you know, get to this level where you would be on the board or something, or would you like to be hands-on? You know?
No, I don't like being on the board as much as because it's just regulatory rubbish you get involved. But I mean. And also, to a certain extent, you get all the sort of like the fiscal and all that kind of stuff. And you know, I prefer not to. I prefer to be a shareholder, more objective on the other side rather than actually on it. I mean, if I had to, I would do. If I had to really get my hands involved and roll my sleeves up. But no, I prefer not to. But. Anyway, you never say never. I mean, one final company that I haven't mentioned, which is, again, it's a good sort of like rough rule for investors. It was an RNS reach from Verici this week, And the reason why I pointed out is because most people sort of diss RNS's reach because it's not significant. However, they said basically one of their non-execs, in fact, founder Barbara Murphy, had just won a Lifetime Achievement Award. People say, oh, why is that significant? Well, the reason is such that, one, it illustrates the capability and caliber of the directors on that board, that they're prepared obviously to back the business, but also, to put their name and to be endorsing this business. And then you actually have a look at their advisory board, which is not on the exec team, but it's their and they've got the who's who of kidney transplant science and immunodiagnostics worldwide. So again, when it comes to sort of like interpreting some of these RNS reaches, which people think, okay, they're not really significant because they've got no financial value. Well, actually, they're massively, important in terms of backing and endorsing the technology. That says to me, the world's best scientists believe Verici's technology is not only going to be successful commercializing it, which is what all the investors really want, but also these guys want to help literally millions of people around the world have better outcomes for their kidneys and other other transplant parts, other transplant organs. Plus, it will save the healthcare system's massive. So when you have such a high caliber board and advisory board, which is backing a company, that just says a lot that this isn't a Me Too stock. This is something they've really got a lot of science, and that's why.
I saw your interview with both of them, the CEO Sarah Barrington and
Barbara Murphy,
But she used to sit in the background, just not quite modest, not saying anything.
Yeah,
she looks like she's an extraordinary thing by creating this.
Yes,
she sits there normally like my mother would, just in the background, and say, "Wow!" And then you get this, the American Society of awarded her a Lifetime Achievement Award, and you think, "Wow, that's amazing." But I like Verici. I mean, the interview I did, then I interviewed them. They have got something special there in that, so it's worth keeping an eye on. Definitely,
she's unassuming like you, Justin.
Exactly. Like yourself. Right, anything else, Paulie?
No, I think we've probably covered a lot of material there.
And don't give up the enthusiasm. I love it when you say welcome back, because it feels like an ad break has happened, and I'm doing what?
And before we finish, if any investors want to actually sort of like follow those companies, hit the buttons on the relevant Vox website, because you'll get all the news. You'll get all the news immediately into your inbox and all the commentary as well. And you might even see me on some of the videos, particularly the one when I speak to Christopher Mills next on Monday.
Yeah. I'll watch that, definitely. Marvelous stuff. Like I said, it's on
video.
I
hope you managed to sort your holidays out and go to the Balearics.
Well, do you know what? It's like the trouble is now, when you go on holidays, you've got to relax. You'll be sitting there thinking, is this going to be moved up to the red zone? And I hope not. You can't relax on holidays. So that's the problem. I think we just give it a miss.
What you should do is stay down in Cornwall or Devon and go mackerel fishing this time and catch some mackerel.
Sounds good.
All right,
stuff. Speaking next week.
Yeah, cheers, Matty.